Welcome back to the channel. My name is Stephen Nguyen. I'm a pharmacist and I own 52 units of real estate. So I had a question in my comment asking more about my life insurance policies and how they work. So I have two videos talking about it, but I have a variable universal life insurance policy through Nationwide, and I have an index universal life insurance policy through Transamerica. If you want more details on those videos, check them out. Just search life insurance in my channel and it'll populate. But basically, the question was more diving into details is, do your cost and fees go up over time? And does the cash value um, go up or down over time? So, and how does it work, right? So for me, I actually studied to be a life insurance agent, passed the exam, sold one policy, and realized I hated it. So, and honestly, the exam was easy. They didn't really teach me much, but this is just what I've learned from analyzing my two life insurance policies, as well as just talking to my, financial advisor or life insurance agent. They're called financial advisors now, sound fancier, but life insurance agents. And basically, what I learned is over time, as you age, the cost of insurance goes up, right? And it makes sense because the older you are, the higher the probability of death and disease, right? So if you have a life insurance policy at 18 years old versus 28, the 18-year-old life insurance premium or fee is going to be cheaper compared to somebody who's 28 and their premium and fee, right? It makes sense. The older you get, the more your cost of insurance goes up, right? So even though every month, let's just say I pay 500, $1,000 a month into my whole life insurance policy, right? When I'm, let's say, 25, I pay $1,000. Let's just say $200 goes to fees. I'm just making this up, right? And life insurance gets a bad rap for fees, right? So I'm paying $200 goes to fee, $800 gets invested into like index S&P 500 fund, right? So 25. Now let's say I'm putting $1,000 a month for 10 years, and now I'm 35. Well, out of that $1,000, since I'm getting older, my cost of insurance is going up. So now, for sake of simplicity, let's say the cost of insurance is now $300 a month, up from 200 because I'm older. So if I put $1,000 a month, 300 goes to the fees, and 700 gets invested, right? So over time, the cost of insurance goes up, right? Because you get older, right? And when you get older, your fees go up. So even though you're paying the same every month, your fees are going up, and the amount that you're investing goes down, right? So, and the next piece is, if depending on your life insurance policy, if you have a growing death benefit, so as the money grows, as it gets invested, your death benefit can go up. So you can start at a $1 million life insurance policy, then over 10 years, maybe now it's a $1.1 million life insurance policy. What does that mean? If you buy more life and death benefit, you buy more life insurance, your cost goes up as well, right? So over time, if your death benefit is going up from 1 million to 1.1 million to 1.2 million, your fees go up. As you age, the fees go up, right? So that's how life insurance is affected. For the cash surrender value, so the cash surrender value goes down over time, right? And why is there a cash surrender value is because for life insurance, they want you committed and paying every single month for at least usually 5 to 10 years, right? Because they don't want you, it's a long-term investment, right? So they create a surrender charge value for the insurance company to protect themselves and give you skin in the game. So let's say I were to cancel my life insurance policy right now. I have a $30,000 surrender value. So basically, if I have $100 in cash value and I were to cancel my policy, they will take $30,000 and then pay me $70,000, whatever is left, right? And just know over time, the longer you own the policy, the more money you put into the policy, the cash surrender value goes down, right? So after 10 years, let's just say at the beginning, the surrender value is $50,000. After 10 years, as you put money into it over the time, the cash surrender value will be zero, right? So hopefully that makes sense. I know life insurance gets a bad rap for fees, and I get it too. I like Vanguard index funds because the fees 0.04%, which is very little, versus the average fee of life insurance over the term of life insurance is about 1%, right? Which is high. But it serves a different purpose. So how I do life insurance for me, and I'm a higher net worth individual at 6 million, is I like to max fund my life insurance so that more money gets invested, right? And then that money grows tax free, and I can pull it out tax free as a loan. So what I do is I want to max fund this money over 7 years because that's what's allowable by, I think, the IRS or the tax code. If you fund it too fast over 7 years, then it gets treated like an investment and you lose your tax benefits or your tax advantage of being tax free, right? So let me make a really simple example. Let's just say for 7 years, I could put $100,000 to max fund this life insurance policy, right? So every year I'll put in $100,000. They'll take out their fees for the cost of insurance, and whatever is left gets invested into an index fund, right? So over 7 years, I can put in $700,000, right? So the most you can do every year is $100,000, or you could put in like zero for the first like 6 years. On year seven, you can lump sum $700,000, right? If you were to put $700,000 in year one, you would lose the tax advantage. It's called a MEC, Modified Endowment Contract, and then you lose your tax-free benefits. So you do not want to max fund it beyond 7 years. And usually your life insurance statements that they send you quarterly will state how much more you can put in before it maxes out. So how it works is the bigger your death benefit. So if you have a $1 million death benefit versus a $2 million death benefit, the people with a $2 million death benefit can put more money into the policy as an investment versus a $1 million, right? And as the death benefit grows, that means your potential to put in more money grows, right? So this is really good when you're working. Like right now, I'm working a W-2. I want to work. I'm motivated. I'm max funding my life insurance policies, right? And let's say in year 7, it's approaching year 7. I think I got my policy in 2019. So it's been 5 years now. So 2 more years and I'm done, or max funding it. At that point, let's just say I finished max funding my policy. My death benefit's going up. So remember, I'm getting older. So my cost of insurance is going up. My death benefit's going up, so that's going to go up more too. So I have more fees, right? But let's just say I said, you know what? I don't want to work anymore. I'm going to retire. And I finished max funding my policy. At that point, I would tell my life insurance agent, say, you know what? Let's start lowering the death benefit now, right? So the more money you put into your life insurance, and this is another crazy topic, which I might lose people on this topic, but let's just say you have a $1 million death benefit, right? But over time, you socked in $500,000. So since you have $500,000 in cash value and a $1 million death benefit, in reality, the life insurance is only giving you $500,000 of death benefit, right? So the more your cash value goes up to your death benefit, the more your death benefit goes, your cost of insurance will go down. So that's where it gets a little powerful, right? So, for example, let's just run my situation. I bought a $2 million life insurance policy. I max fund it for 7 years. By year 7, it's worth 2.5 now, right? In terms of the death benefit. Now I want to stop max funding it, and I'll say, you know what? Let's stop here at 2.5. And let's just say, for simplicity, I built up $500,000 in cash value. So now I have $500,000 in cash value and $2 million in death benefit to make up that $2.5 million life insurance policy, right? And now every year, gradually, my life insurance agent will lower my death benefit by 10 to 20%. So let's just make it easy. So I'm at $2.5 million with $500,000 in cash value. And let's just say in the next year, I lower it by, let's just do it 20%. So let's just make it $500,000 for simplicity. So now went from $2.5 million death benefit to a $2 million death benefit, right? But my cash value is still $500,000. Let's just make it $600,000 now, right? And then the next year, I lower it again by another 20%. So now it's at $1.5 million. And then my cash value is $700,000 now, right? So why people do that is because your fees will start to go down, right? Because remember, your insurance will be going down because you're lowering your death benefit, but your cash value is going up as well, right? But you still have the fees going up from the cost of insurance because you're getting older, right? So the only factor you're paying for is that you're getting older, so you have to pay more. So where it gets really powerful is when, let's just say you have $1 million death benefit and you have $1 million cash value. That means your cost of insurance is zero, right? At that point, the only fees you're paying are the fees to maintain that life insurance policy. And that's when it becomes powerful. Because now I have $1 million, very little fees, it's growing tax-free now, right? So that's how the rich use life insurance, like really long term, right? So what you want to do is you want to max fund your policy every 7 years. max fund it as long as you can, and the moment you want to stop, you stop max funding it, and then you still continue to make your payments, and then you're going to gradually start to lower your death benefit until the point where your death benefit meets your cash value, right? So you want to gradually lower your death benefit, let's just say to $1 million, as your cash value builds up to $1 million. At that point, your cost of insurance is zero. You're just paying fees to run the insurance policy. The insurance needs to make money, and then it grows tax free. So let's just say you have $1 million and you do 7%, which is $70,000 a year, and that's tax free, right? And that's a good income, right? Tax free, right? That's a really good income, tax free. So that's how you do life insurance. That's how you do it long term. I know a lot of people say it's a scam, and like I said, it's how you use the tool. So you have to max fund it. You have to have a life insurance agent who knows what they're doing, and you have to be committed to it long term, right? It's not good for those who just want to buy it for protection. If that's the case, just do term, right? Life insurance is a game for hard net worth individuals, and for those who are committed to it long term. And you have to commit to max funding, and then you have to, after you're done max funding, then start lowering your death benefit. And usually life insurance companies let you lower your death benefit by about 10-20% a year, is what my agent told me, right? So eventually you'll lower it to the point where your cash value meets the death benefit, and that's called self-insurance, right? So that you have zero risk to a life insurance company because there's no risk with you, and that's when fees drop. So hopefully this answers your question. It's probably a confusing topic. Listen to this a few times, digest it, like, comment, subscribe. Let me know any further questions. If you want to learn how to buy some real estate to then go use that cash flow to max fund your life insurance policies like me, check out my mentorship program. Hope to see you next one. Thank you so much.